It's really interesting when you ask investors what they look at when they're buying an investment property, because I think cash flow is one of the most important things to consider. And yet, in my experience, a lot of investors, when they're looking at a property, might just look at what rent's going to come in and what the mortgage payment's going to be to determine whether or not a property is going to cost them or not. Now, a more sophisticated investor will look at things like rates and insurance, but an advanced investor will look at things like maintenance and vacancy, accounting costs, bank fees, all those other kind of things that in the real world the property is going to cost, to determine a really appropriate amount to be putting aside every week to make sure that you've got money for a rainy day. So if you don't do a cash flow budget or appropriately account for things that might happen in the future, what might happen is you might get a month of vacancy, or you might have a large maintenance bill that you won't have the money in your account to pay, and that will put undue stress on you, which you don't want as an investor. The reason it's important to know the cash flow of your entire portfolio is because some properties might be cash flow negative, i.e. cost you money, and some might be cash flow positive. And it's important to get that balance right, because we all have a limited amount of money that we can contribute to any kind of investment, so we want to make sure that there's balance there. So I want to use another example now, and today I've looked at an Auckland property for a purchase price of $750,000, and I've done two scenarios. The first based on 100% borrowing, and the second based on using a cash deposit. First of all, I've worked on a purchase price of $750,000 and set up costs of $3,500, which I've added into the loan to give a total mortgage of $753,500. Now the rent, $600 a week. We always take out, in our examples, 3 weeks for vacancy every year. So we're budgeting on 49 weeks of actual rent received. I've allowed interest on the loan at 3% per annum. I've allowed for property management of 6.95% plus GST. I've allowed for a letting fee every year. So I've put that in as an annual cost, even though if a tenant stays for 3 years, you'll only pay that once over a 3-year period. But we like to err on the side of caution and allow for that as an annual cost. I've allowed for rates of $2,800, insurance of $1,700 a year, maintenance I've allowed for $750 per annum. So that would be a newer property. If you had an older property, you might allow for somewhere between $1,000 and $1,500, or if it was a really old property, it might be $2,000 or $3,000 a year, especially if you've got some deferred maintenance. The other thing that I always account for is accounting costs, because you have to pay an accountant to file your tax return, and for your first property, that's generally about $1,000. So all up, the cost for a client that's buying an investment property with these costs and this income, the top up is $48 a week. So this property is negatively geared by $48 a week in the first year. Now, obviously over time that rent's going to go up, so that number will reduce over time, but for now they've got to find $48 a week to own that rental. Now, in 15 years' time, if that property increases by 6% on average per annum, then the projected property value is almost $1.8 million, which means it's got equity of 1.043, which is pretty impressive, a great return for that $48 investment. Now the next example is exactly the same for numbers apart from one difference. The difference is a cash deposit of 20% plus the $3,500 setup cost. So a mortgage of $600,000, which is 80% of the purchase price. Again, all those other costs remain exactly the same. This property is now cash flow positive by $41 a week. So after the rent minus vacancy and all the costs have been deducted, there will be $41 a week income. In 15 years at 6% growth, the value is exactly the same, but of course the mortgage is only $600,000, so the projected equity is about $1.2 million. This type of example, a $750,000 property getting a $600 a week rent in Auckland, might be something like a townhouse, a 3-bedroom townhouse in Avondale, for example, or Hobsonville. So one thing to consider when you're looking at investing in property is, if you're making a contribution, is it affordable first of all, but are you getting value for that contribution? Because every investment requires a contribution one way or another. Now, if you're making a contribution of $50 a week, obviously you want to see some good growth on that, but you can probably tolerate not seeing growth 1 year and it not being too much of a mental barrier. Take a flip side of maybe a contribution of $500 a week, which might be more akin to an Auckland contribution, say 5 years ago. That's probably quite challenging to pay out $25,000 a year if you're not seeing the growth in that area. So these are things to consider. What if I've got a property that's not cash flow positive? Just remember that is okay, because if you're borrowing 100%, it is often cash flow negative when you look at a true budget that factors in all of the costs. Now, sometimes people trick themselves by removing some of those things like maintenance and accounting and vacancy to make something look more cash flow positive than it actually is. The other thing is you're doing this with no cash down if you're using your existing equity to borrow 100%. So there is no type of investment where you can get a return without contributing something. I do see examples all the time where people haven't considered things like the letting fee or accounting or vacancy or maintenance, and that could affect your cash flow by $80 or $100 a week. So again, it can appear that a property is cash flow positive even when it might not be if all of these things happen. And I think it's better to err on the side of caution and plan for the worst case scenario. So you've got money in the account if you need it in the future, and be surprised and delighted when you don't actually have all of those costs occur. Often the first year of property ownership can be the most expensive year, and the reason for this is because over time your rent will increase, and generally speaking that's about 1% above inflation, so maybe 3%. On the other hand, your expenses, your operational expenses, which make up about 40% of your costs, they go up by inflation, so say 2%. So as time goes on, there becomes a larger and larger gap between the rent going up and the costs going up, but at a smaller rate and at a smaller percentage. So your contribution tends to go down over time. Sometimes I talk to investors and they might make a tax loss of $10,000, but actually be owning a cash flow positive investment property. And again, this can be things like depreciation, which is not actually a cost that you're paying out, but is a tax cost. So just remember, this is not the best guide to work out your cash flow. It's just an accounting statement. Now, it's okay to make a tax loss if your property isn't costing you, or maybe even is making a profit. In fact, it's somewhat desirable. So again, if you factor in those things like depreciation and home office, it might be from an accounting perspective that you make a loss of $5,000 this year. That means that the $5,000 profit that you make at a later date won't be taxed, so you don't have to pay income tax on that $5,000 because they offset each other, and the $5,000 loss that you made this year is kept with the bank of the IRD.